Hey everyone, welcome back to the channel. My name is Gaurav and today I will be talking about the history of real estate in the Greater Toronto area, the crashes and recoveries we've had, and what does it tell us for the market in 2026. This video is meant to be a comprehensive resource on the GTA real estate history built on historical data to help you form a clear and informed opinion about where the market may head in 2026. In this video, I will talk about three things: how the GTA market has performed since the 1970s, the major booms, crashes and recoveries, what all of this means for buyers today and in 2026. Imagine buying a home at the peak of the market frenzy, only to watch its value drop by a third in just a few years. This has happened more than once in the Greater Toronto area, but when you zoom out, the long-term picture looks very different. In 1970, the average home in the Greater Toronto area sold for around $29,000. Today, that number is roughly 1.1 million. That is a 38 times increase over a little more than 50 years. On a straight line, that works to about 6 to 7% price growth per year on average. So even though there were nasty crashes along the way, the long-term trend has been consistently upward. If you break that growth into 10-year chunks, you see the pattern even more clearly. Most 10-year periods since the 1970s have roughly doubled your money in nominal terms. The only real exception is if you bought right at the peak in the late 1980s and measured your return in the middle of the long 90s slump. Since 2000, the story is similar when you look at 5-year periods. Every single 5-year stretch from 2000 onward has ended with prices higher than where they started. In the softer periods like the early 2000s or right after the financial crisis, 5-year gains were in the 20 to 30% range. And in the hotter periods like 2011 to 2016 or 2015 to 2020, 5-year gains were closer to 50 or even 60%. So even with the corrections, which we will talk about later, anyone who held for at least 5 years after 2000 has done reasonably well on paper. Now within that long-term uptrend, there were very clear boom phases where growth was way above the average. In the early 1970s, you had high inflation, rising wages and a growing population. Real assets like housing became an inflation hedge and the prices in GTA almost doubled over just a few years. In the mid-1980s, interest rates started falling from the extreme levels of the early 80s and the economy was recovering. And that combination of cheaper borrowing and rising confidence helped fuel a huge run-up in prices leading into the 1989 peak. Then after the global financial crisis, from around 2011 through the 2015s, you had very low interest rates, strong immigration into the GTA, and limited supply. That created another powerful multi-year boom. Most recently, during the pandemic, ultra-low rates around 0.25%, work from home, and a surge in demand for more space pushed prices up by roughly 50% between 2020 and early 2022. Now let's talk about the most severe crash the GTA has ever seen, the one that started in 1989. This downturn didn't happen in isolation, it came immediately after one of the strongest booms in the GTA history. From 1985 to 1989, home prices almost doubled. Cheap borrowing, falling interest rates compared to the early 80s, rising wages, and a lot of speculative buying created an environment where everyone felt like the prices could only go up. Inflation was becoming a major concern and the Bank of Canada stepped in aggressively. By 1990, mortgage rates climbed to around 14% and that was the breaking point. At the same time, unemployment in Ontario pushed above 9% as manufacturing jobs were disappearing and the country slipped into a recession, triggered partly by the GST rollout and a weaker economic outlook. Prices didn't just fall for a few months. They fell for about 7 straight years, from 1989 to 1996. From the peak to the bottom, average prices dropped roughly 30%. The recovery only began once the broader economy started healing. Interest rates finally came down, unemployment eased, tech and finance hiring picked up in the GTA, and immigration brought in new demand. After the long recovery from the 1989 crash, the next period of uncertainty came during the global financial crisis in 2008. But the story in GTA was very different from what happened in the United States. When the US mortgage market collapsed, confidence here took a hit and sales dropped sharply. But the prices did not fall. In fact, the TREP data shows that average GTA prices stayed stable in 2008 and even increased again in 2009. Because Canada's banking system was way more conservative and lending standards were much tighter, the housing market held its ground here. Once interest rates were cut and stimulus entered the system though, buyers returned quickly and the market moved into a strong recovery by 2010. So unlike 1989, which was a deep multi-year correction, the 2008 period in the GTA was a confidence shock rather than a price crash, and the market bounced back fast. Now let's talk about the correction we are in right now, the one that began after the peak in early 2022. But before we get into the decline, it's important to remember what happened just before it. From 2019 to early 2022, the GTA saw one of the fastest price increases in its history. Ultra low interest rates and work from home environment pushed demands to a level we had never seen before. Mortgage rates were 0.25%, approvals were easy, and everything was selling within days. Prices went up roughly 50% in that short period. Then the Bank of Canada raised interest rates from 0.25% to 5%. This was one of the fastest tightening cycles we've ever seen. Overnight, monthly payments became 2 or 3 times higher, and then came the downturn. What makes this downturn unique is that the job market didn't fall apart. Unemployment stayed low in the 2022 and the 2023 period, partly because of record immigration. Now, at the same time, inflation ran up and was the highest it had been in 30 years, forcing the Bank of Canada to keep the rates high for much longer than anyone expected. Prices eventually started coming down from the peak in 2022 and kept softening through 2024 and into 2025. By mid-2025, activity picked up a bit when the number of transactions stabilized, but prices did not bounce back because supply stayed high and the immigration targets were reduced. Now, this downturn isn't like 1989, which came with job loss and a recession. It isn't like 2008, which was a financial panic. The post-2022 correction has been driven mainly by affordability, higher borrowing costs, and a weak macroeconomic backdrop. But before we talk about what all of this means for 2026 and where the market could be heading next, there's something important I want to talk about. I want to talk about why should someone even buy a house in the first place. Buying a house is hard. It's not a quick flip, it's not a shortcut to getting rich, and it's definitely not something you casually slot in between the weekend plans. I have had people reach out saying they want to buy a home, but they aren't ready to reschedule a single weekend plan to go see a property. And I completely understand. Life is busy, family commitments matter, everyone has limited time. But that is exactly the point. Buying a home is not something you casually fit in around everything else. For a few weeks or months, buying a home will have to become your priority. It takes time and energy, and it is a process that might prove to be tiring and emotional. We forget this because the internet makes real estate look very easy. There's a constant stream of find the perfect deal, flip a house, build instant equity, buy a power of sale, make a lot of money. And in this noise, a lot of people lose perspective of things. The truth is that the happiest clients I have worked with were not chasing quick gains. They were not trying to become overnight investors. These were people who wanted stability for themselves or their families, and they wanted a space that was theirs. Those are the buyers who look back and say it was worth it. Everyone else just eventually realizes that real estate is not a get-rich-quick scheme. And yes, there might have been a few people who made big money during COVID, but that was a once-in-a-generation environment with near zero rates and a market moving at unnatural speed. Such a market was a black swan event, and it's not something anyone should expect to repeat. So if someone decides to buy a home, the motivation cannot just be that prices might go up. It has to come from the qualitative aspects: stability, family, control over your living space, the feeling of building a life. Those are the reasons that last. The speculative ones do not. Now we come to the big question: what does 2026 hold for the GTA housing market? We've looked at long-term growth, the booms, the crashes, so let's bring it all together and look at where things stand today. Interest rates have come down to around 2.25%, and most economists expect them to stay in this range for much of 2026. That means borrowing costs may not improve dramatically from here unless incomes rise or prices soften further. Now, immigration will remain strong, but not at the explosive levels we saw in the pandemic years. Permanent resident targets stay high, but temporary resident numbers are being reduced, which naturally slows overall population growth. The job market is also showing signs of slowing. Unemployment has inched higher, GDP growth is expected to be modest, and the business confidence has taken a hit from the ongoing US trade tensions. I have personally had a number of conversations with people who are unsure if they will have a job in the next year or not. So what does all of this mean for 2026? Well, we are more likely to see stability or mild declines than a big jump in prices. Affordability is still the biggest problem. We have a slowing population growth and high levels of job insecurity. If we have a high inventory in 2026, then this may give buyers more negotiating power. Any recovery at all is likely to be gradual and not sharp, in my opinion. But at the same time, if the economy weakens or rates rise again, we could see prices drift down a little further. So the best mindset for 2026 is simple. Don't buy because you think prices will skyrocket. Buy when your timing, your reasons, and your finances actually line up. Real estate is a long-term decision. It is not a short-term speculation play. If you found this video helpful and you want to understand Canadian real estate or the US stock market in a deeper, more practical way, make sure you hit that subscribe button. I post research-driven content to help you make smarter financial decisions, whether you're thinking about buying a home or building long-term wealth. Thanks for watching, and I'll see you in the next one.